Hello, welcome to the December 2024 market update. Let's get rolling. You know the team, so we're going to go on past that.
I'm Max. It's Victor.
I'm Victor. Josh is behind the scenes. You already know our underlying thesis, so let's roll.
All right, so the major market indices. We had a sharp downturn yesterday. The Dow is up this year 12.5%. The S&P 500 is up 23.5%. And finally, the NASDAQ is up almost 30%.
And those are after the sell-off,
After
right?
the sell-off, after Jerome Powell spoke.
Yep. What did Jerome say that caused such a big reaction?
Jerome basically came out. There was a 98% likelihood that he would cut a quarter of a basis point. He did do that. However, in 2025, he forecasted instead of doing a full 100 basis point cut in 2025, he's only going to do a 50 basis point cut in 2025.
Yeah, let me also throw in, this was also the Jerome Powell that said before 2022, we don't see a 100% or 1% increase in interest rates. And then he did five consecutive 50 points, and he ended up raising rates 20-fold from a quarter of a point to 5.5 points. After in March he testified before Congress he would not do it. So this is yet to play out.
Exactly, Victor. This is yet to play out, and we'll see what happens.
Yep.
Absolutely. That's where you can see the big sell-off. We've been down 10 straight days in the Dow. You can see that in the chart, those red marks going straight down. All right, so the S&P 500 is doing better than the Dow. That's on a trendward up.
But let me ask you a question, Max.
Yeah.
If you look at that trend, overall, would you say that trend is down, sideways, or up?
I would say that's up.
I would say it's
even
up
after yesterday.
Absolutely. We are in a confirmed secular bull market.
And the NASDAQ, Victor, I'll ask you the same question. Is that down, sideways, or up?
Let me see. It is undoubtedly up. All three indices, the Dow, the S&P 500, and NASDAQ, are all in confirmed uptrends, even after yesterday's actions.
Correct. All right, Vic, you want to do the perspective?
I'm going to do this, and I've been doing it a few times, but I'm just trying to put things in perspective. So here we go. It is a gloomy moment in history, not in the lifetime of any man who reads his paper has there been so much grave and deep apprehension. Never has the future seemed so dark and incalculable. The domestic economic situation is in chaos. Prices are so high as to be utterly impossible. The political cauldron seethes and bubbles with uncertainty every day. The United States is beset with racial, industrial, and commercial chaos, drifting we know not where. Russia hangs like a storm cloud on the horizon of Europe, dark and silent. It is a solemn moment, and no man can feel indifference. Of our own troubles, no man can see the end. We're going to come back and why that's so important.
When was this written?
That's what I'm going to tell them later. Don't say that now.
All right, income and yields. They were affected a lot yesterday. So let's see, the 30-year bond is at 4.7%. Let's do the 2-year is at 4.3. The good thing is we're not in an inverted yield curve.
Yeah, watch this. Go to the next slide.
We'll go to the next slide.
There we go.
All right. So a year ago, we were in complete inversion, which basically means that the lower end yields, the 1 to 3-year yields, were higher than the 30-year. So that means it's inverted. And now we can see the blue line, the current, means that the lower end of the yield curve is lower than the higher end.
The longer you go out, the more you get paid. I think, and I'm not sure, but I'm pretty sure this is the first day after yesterday we reverted back to a normal yield curve.
Correct.
Yeah, okay.
All right, the Federal Reserve begins lowering interest rates. So, yes, they did cut 25 basis points, but we were forecasted next year to cut another 100 basis points, and we only are going to, Jerome Powell now says they're only going to cut 50.
We'll see how that plays out.
Yeah, exactly. So, lower interest rates benefit high income generating securities. Look for companies with a history of raising dividends. That's the dividend portfolio Victor and I run. that is, it has to have a consecutive history of raising dividends.
At least 7 and 10 years raising their dividend. They have to have an A quality credit rating. They have to have a management that supports dividends. And that's going to be
and
the
they have
key.
to be making money.
Oh yeah, that's the key. And they have to be making. They have to have earnings to support
the dividends.
Yep.
All right, dividend stocks and utilities and REITs historically perform well in low interest rate environments. And for a list of those quality dividend companies, give us a call.
You know, before you go on, the interesting thing about REITs are real estate investment trusts. One of the biggest benefactors of AI is the building of what?
Data centers.
Data centers. Data centers are needed to make AI. They have all this data, and then when they have it, they got to do what?
They got to give
They
it to their
got to store
investors.
it somewhere. Yeah. And that's where these data centers come in.
All right, 2024 year in review. Where have we come, Vic?
All right, 2023, here's the issues we were looking at. China and Ukraine, the Fed was hiking rates, or just done it. The banking system was in turmoil because rates went up so quick. AI had just started to begin. Only AI has been around for a long time, but it's just really coming to its productivity. And the IPO, initial public offering market, was just beginning to revive. That was the end of 23.
All right, so the headlines of 24. Investors are confident in a March interest rate cut. Biden, the Gaza ceasefire, and the U.S. spending $300 million in ammunition, weapons in Ukraine. Fed cuts rates by 0.5 percentage point. Netanyahu says intensive fighting in Gaza is close to ending. And
Has it ended?
No.
Oh, sorry. I just wanted to make sure.
And then in 2024, Donald Trump is elected the 47th president, and Harris concedes. And then we will see what 2025 happens. But the important thing is, with all of these major headlines, the Nasdaq is up almost 30%.
Yep.
The S&P is up almost 25%, and the Dow is up about 12%. So we've had after yesterday's sell-off. So we've had a historical run, even after all these negative headlines. So where are we now, Vic?
We're in Boynton Beach. Oh no, that's not the right thing. I mean, if you look in January and February, we had the first things of positive signs. March and April, the Fed really started lowering interest rate. We got to May and June, and earnings were coming in strong. As we got near the end of the summer, the Middle East erupted into a number of different issues. And then finally, at the end, they talked about a ceasefire. We had a monumental change in administration in the presidential election. And we will see what we're going to get going forward.
All right, so the 2024 return so far, December obviously isn't there, but we've had every single month was up except for April and except for October.
And what are the worst 3 months of the year historically?
August, October, and September.
August, and look at that. August was up. September was up. September's often the weakest. And October. I mean, some of you remember the crash in 87. We were down, oh God, I don't remember, 35, 40% in one day. All right. This October, down 1%. Those are very strong for the weakest months of the year.
Exactly. All right, so AI, we've talked about AI before, numerous times for months, and so it continues to impact the industry. So Victor was talking about data centers. Vic, do you want to go further into it?
Yeah, if you look at that map up there, all of those blue areas are data centers and where data centers are being built. And it's interesting, if you look, there's a big concentration in the Northeast. The Northeast consumes an awful lot of data. There's the logistics that can give them the natural gas they need. There is the need for the research. There are the utilities that support it. And we're seeing that all built up. That's a major play going forward.
So the demand for data centers is just beginning. It's just growing on the right-hand side. That's just the data centers in Virginia. So there's 475 data centers just in the Virginia area.
That area is the largest concentration of data centers in the world.
So AI growth fuels demand for data centers to handle massive data storage and computation. Data centers are energy intensive and require robust infrastructure. Victor talked about REITs that own a few data centers. That's Digital Realty Trust and Equinox. So we have a couple of those in the portfolios for this purpose.
Yeah, and you're seeing a resurgence in the demand for energy. For the last decade, electricity, has only grown at an annual rate of 0.4%. And that's because you can't just make people use a lot more electricity. However, AI comes out, and for an AI computer to process, it takes how much more than a regular computer? 10 times more. And we're seeing a bigger and bigger demand for these centers. So all of a sudden, electricity, the transmission, the fuel, and the need to storage is impacting the entire utility industry.
Surprisingly, we use no oil for electricity.
Yeah, that was interesting. We attended we had a workshop yesterday by the Department of Energy, Raymond James Energy Analyst, and some company that does all that. I forgot their name, candidly. And one of the things came up, we use very little oil. Most of our energy right now is done by natural gas. The second is coal. And wind and solar are coming in. But there's a problem with wind and solar, and that is this. AI and the data centers need 24/7, 365-day reliable energy. You all remember 2 years ago, Texas had this big ice storm come down. The windmills froze in place. There was no sun because it was all overcast. So wind and solar can generate electricity, but it cannot generate 24/7, 365-day reliable. It's going to be natural gas is the number one. Our coal usage is actually declining, but what's happening with coal usage in China?
It's going way up.
China is using an awful lot of coal.
All right, so the bright futures for dividend stocks. Bright futures for dividend stocks, we talked about it with the data centers and the REITs. Investors should focus on utilities and REITs and energies for dividend growth. Look for those companies to provide a stable income, and dividend-paying companies in energy, power, and data infrastructure are well-positioned for AI growth.
Absolutely.
So, the election impact, we saw a historic run right now since basically November 5th all the way until yesterday. We had a huge historic run. The S&P, as of election day, went way up. And so here's how the market performed before and after the 2024 election. Vic?
Yeah, look at it. In October, it was still, all the polls said it was very close. As it ended, it turned out not so close. So October, we were down 1% for the month. All of them down a little over 1%. In November, after the election, and let's just be candid, you now have a pro-growth, pro-corporation, anti-regulatory administration. And look what happened in the switch. The Dow was up 7 1/4, the S&P 5 3/4, NASDAQ over 7.
Mm-hmm. All right, so U.S. stock returns during Trump's first term. What performed the best? Top 15. What were the bottom? We'll go through a few. The software was number one through Trump's first term. The bottom two were oil and gas and energy, surprisingly.
By the way, it's interesting you say that. If we get the new administration, and they do a lot of drilling, drill, baby, drill, is that good or bad for oil companies?
It's good and bad at the same time.
You running for office?
And the reason is because they're injecting more supply, but the demand is still the same. Yep. So if they're injecting more supply into the market, then the prices go down. So is that good or bad for oil companies?
Yeah, they're not going to make as much as they were before when it was 70, 80. We're still in the 70s. But, Max, what have you seen when you went to fill your car? Have you seen any drop in gas prices in 2 months?
Yes, in the past 2 months, drop in gas prices.
Significantly. We're paying right in at least Broward, Palm Beach County, somewhere between $2.85 to $3.19, where before we were over $4.
Yep. So this is what we just talked about. The the election trade, the top during Trump 1.0 stock market returns. IT did the best, and energy and staples did the worst.
Yep.
So Victor, want to talk about the elections?
Here's something with presidential election years. On average, presidential election years are up about 11%. But look at this. If a Republican is elected, they're up a little over 16. And then do we have the next slide, or is it just, okay, you can go back. When a Democrat is elected, it's up around 9. The average overall, is about 11%. They're still very positive years. And it's across all the administrations.
Yeah, and if you look for the bright future for stocks, every administration did well except for George Bush, but he had the dot-com bubble and the financial crisis and 9/11. Yeah. So he had 3 major things in him. And then Richard Nixon, and then if we look to the far right with Joe Biden, that'll actually probably be higher than 10.2 because of the end of 2024.
We'll end up 12 to 14 on the Dow. We're still up 12 after the sell-off. You know, it's funny because we were overbought in the last 10 days. We become oversold.
Yeah.
But that's on a short-term basis.
But if you look at the major thing on this chart, if you invested $10,000, that's the far left side.
Yep, down on the bottom.
Down on the bottom, $10,000. Where would it be now? It would be at $5.1 million.
If you look at that sort of that brownish mountain chart underneath, that's 10,000 with Kennedy up until now. Well, actually, November, that goes to 5 million and change.
Wow. That's a good amount of money.
It is.
So, our consensus, the last time we witnessed similar economic and political conditions was in 1980 with Ronald Reagan administration.
Yeah. Today's situation is very similar to them. If you'll remember, we had Paul Volcker, the head of the Fed. We had 21% prime. We had treasuries 14 and 7/8. And then in 81, he started to lower rates. 1981, we had the change from Jimmy Carter into Ronald Reagan. So you have 2 things very similar today. You had the Fed changing direction, that is lowering interest rates. And then you had a pro-growth, pro-business, anti-regulation president come in. That resulted, watch the third paragraph, from 1982 to 2000. Similar economic conditions that we had then, we have now. The Dow went on an 18-year streak from 800 to over 11,000.
That's a pretty good run.
That's not bad. There were some bumps on the way, but that's a darn good run.
Yeah. And that was fueled by tax cuts, deregulations, and a prudent Federal Reserve actions.
Absolutely.
So, why timing the market is difficult? Look at all these ups and downs. We've gone through this before. Basically, the consensus is it's better to be in time in the market rather than timing the market, because
it's so difficult to time the market.
It's so difficult to time the market.
By the way, I was reading some stuff on a guy named Warren Buffett. Does he time the market?
No, he doesn't time the market.
He seems to do pretty good, though, doesn't he?
Yeah, he does okay.
Time in the market, not timing the market.
All right, so raise cash or buy the dips, the 82-year review.
So what are all those blue mountains?
What are all those blue things?
Yeah, those
mountains. Those are big blue mountains. Those are bull markets. And the bottom orange, those are bear markets, those little valleys.
So when you do all the analysis, what does it turn out, the average bear and the average bull market? Look at that. The
average bear is about 11 months, and the average bull is 6.5 years.
Wow. So it's basically 6.5 to 1. We have that much more time in up markets than down markets.
Correct.
The down markets hurt. We all get that. Nobody wants to see it down. But overwhelmingly, you stay in there, you get paid for staying in there if you got quality.
Correct. So we provide a historical perspective. Those that fail to learn from history are doomed to repeat it. Those that learn from history can prosper.
Absolutely.
We take the emotion out and replace it with historical context. We just went through that. We just showed you that. Why? Why does history repeat itself and so many fail to learn? Times change, but human nature
does not.
So, thanks for joining us today. And remember, we're here looking out for you.
Thank you for joining us. Oh, yeah. Merry Christmas, Happy Hanukkah, and a Happy New Year.
Merry Christmas, Happy Hanukkah, Happy Holidays.